This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Page 7, Chapter 2, Professional Responsibility and Liability. The Clarity Project. In 2009, all auditing standards now conform to a standard layout. Introduction, objectives, definitions, requirements, and then the application of how that standard should be applied, or examples of the application of the standard. Just give me a moment. Indra only does regular activities. Indra only does regular activities. I shall ask you that tomorrow. I shan't ask you what your regular activities are, but it's a way of remembering. Fraud and error. Fraud is both the use of deception to obtain unjust or illegal financial advantage, but also intentional misrepresentation affecting the financial statements by one or more individuals, among management, employees, and or third parties. It's also an intentional act by one or more individuals, among management, those charged with governance, employees, involving the use of deception to obtain unjust or illegal. The intentional act in order to gain an unfair advantage. Fraud risk factors are events or conditions indicating an incentive or pressure to commit fraud. Oh dear, look at that. Excuse me. I didn't change my setting, I'm sorry. Error would be unintentional. The fraud is intention to deceive or gain an unfair or illegal advantage. It's deception or the intention to deceive. Incentive or pressure to commit fraud. Fraud risk factors. Errors, unintentional mistakes, and we all make errors. Can't help it. The type of error that we all make is called human error. When planning an audit, we should assess the risk that fraud or error may cause the financial statements to contain material misstatement. And based on that assessment, we need to design procedures so that we have reasonable expectation of discovering material misstatement, whether arising through fraud or error. Responsibility for prevention and detection lies with the client. This again is a question which comes up, I'll say, not unusually within a P7 exam. Should it be a requirement that the auditor should be responsible for the detection of fraud and error? And the answer is quite clearly no. It cannot be the requirement placed on an auditor to determine the existence of fraud or error. We plan our assignment in such a way that we have a reasonable expectation of the discovery of material fraud or error, material misstatement arising from fraud or error, but it's not our job. If we suspect fraud, then we should investigate it thoroughly. But if there's no suspicion of fraud, it's not our job to seek it out. There's a very old expression, it goes back into the late 1800s, and there was a judge in a case there. And I hesitate to say this because it's probably inappropriate in 2013 to quote this judge. But if you think about what the judge said, he said an auditor is a watchdog, he's a guard dog. He's not a detective dog. He's not a bloodhound. He's not the Sherlock Holmes type seeking out fraud and error. It's not your job to go into a client's assignment audit and start actively seeking out fraud. If it exists, then you have planned your assignment in such a way that you have a reasonable expectation of discovering material misstatement. But it's not your job to say, "Good morning, I'm here seeking out your frauds." That's not what we do. The watchdog, not a bloodhound. I've mentioned it, I've said it twice now, but there was a comment by the examiner some time ago that said, "Watchdog, not bloodhound," keeps being quoted. This is over 100 years old. It's probably a little bit old-fashioned. It might be old-fashioned, but it still tells you. It still says that you're a guard. You're there in a guardian capacity rather than in a detective capacity. But I'll say this for the third time. You plan your assignment in such a way that you have a reasonable expectation of discovering material misstatement, whether arising through fraud, error. I'm on airplane mode. How come it's ringing?
Barbara.
It's Barbara. No, I'm not answering you. I'm sorry. I'm sorry, I'm busy. I'll call you back. Reasonable expectation of discovering. There we are, detecting material misstatement arising from fraud, error or other irregularity. The responsibility for the prevention and detection of fraud rests with management and those charged with governance. It's the management's job, and that's why in those DevRo accounts we've got 2 pages of risks that they have perceived and the way that they're managing those risks. And if you remember your P1 studies, it's the management's job, it's not the auditor's job. Those charged with governance should create a culture of ethics and honesty within the entity. That culture actively reinforced. It's leading from the front. Those charged with governance, the management, the board, should themselves be seen to be honourable, loyal, trustworthy, honest, people of integrity. And if they are, then everybody else within the organisation will find it easy to follow those standards, that culture. But if your management is corrupt and dishonest and deceiving, then it's easy for everybody else to follow that lead. So it's management's job to establish this culture. Culture should be actively reinforced by active oversight of those charged with governance, by considering the potential for controls to be overridden, accounting and internal controls, which may be overridden. And therefore, if they can identify the possibility of the overriding of controls, then they can take steps to strengthen those controls in order to prevent them being overridden. Considering other inappropriate practices like aggressive earnings management. That was the subject of an audit question recently. What do you understand by creative accounting? What do you understand by aggressive earnings management? What do you understand by aggressive earnings management? Well, you know aggressive, you know earnings, you know management. Put the 3 together, what do you understand?
Aggressive.
It's the management of earnings in an aggressive manner. Does that help? Aggressive earnings management is being forceful in terms of selling at the most high price that you can achieve. It involves forceful and very active pursuing receivables. It involves delaying payments to creditors in order that you keep the money in your possession for longer. It's that sort of thing. It's more difficult, page 8, it's more difficult to detect misstatements arising from fraud rather than from error. Why do you think that might be? Why is it more difficult to determine material misstatement arising from fraud rather than material misstatement arising from error? Why? Because fraud is intentional. And therefore, steps will have been taken by the fraudster to hide that fraud, and therefore it's more difficult to find. Particularly at high level. If it's the management of the organisation which is fraudulent, wasn't it a local bank where the two owners have disappeared with all the money? Yes, it was. Yeah, the two owners disappeared, didn't they, with all the money? And now it's being liquidated. Fraud can involve sophisticated and well-organised schemes, forgery, deliberate failure to record. These are just examples. Intentional misrepresentation, collusion, particularly at management level. And the ability to detect fraud depends on a combination of factors. The skill, the sophistication of the fraud, frequency and extent of the manipulation. Difficult to catch a fraud where it's of immaterial amounts. But if there are a lot of immaterial amounts, that adds up to a material sum. But if each individual transaction involving the fraud involves only 1 or 2 cents, then it would be difficult to see, probably. Relative size of the amounts manipulated and the degree of collusion, the seniority of those involved. What's the difference between frequent and regular?
Doesn't necessarily at the same parts in time limit.
I like to help you remember this if you're trying to distinguish between frequent and regular. If you think about my sex life, it's regular but not frequent. Every 4 years or so. It's regular every 4 years. So be careful you choose the right word. Auditors should inquire of management about assessment of risk, that the financial statements may be materially misstated due to fraud, including the nature of the risk, the extent and the frequency of the assessments. How often does management assess? And again, it's coming back to those Devro accounts where there is detailed analysis of the risks that they have perceived and the steps that they have taken to manage those risks. Management's procedures for identifying and responding to risks of fraud, including specific risks identified by management, risks brought to their attention by others, by employees, and by outsiders, and by auditors, and classes of transactions, account balances or disclosures where risk is likely to exist. It always strikes me as strange that when asked, people will often say, in answer to the question, what is the easiest asset to take if you were to defraud your company? The common answer is cash, because it's instantly usable and highly desirable. But in fact, that's probably the worst thing to take, isn't it? What would be the most appropriate thing to misappropriate from an employer? Here, all of you looking at me with innocence. The concept that misappropriation of assets from your employer is strange to you. Well, hopefully it is strange to you, but people do. Inventory, yeah. Inventory, particularly where it's highly desirable, where it's readily saleable in the local bar. Look what I've got from my employer today. The place in England where I used to live, in this location, there were 2 or 3 bars, 2 or 3 pubs there, where you could go and say to the barman, the landlord, the owner, and say, I need a new pair of Nike shoes. And the barman would say, what size do you take? And you'd say, in English terms, an 8.5, or I think that's 44 here. You'd say 8.5. He said, come in tomorrow at 6 o'clock. And they'd be there on the counter waiting for you. And it's wrong that it should happen, but it's obviously the desirable thing to misappropriate from your employers, because if it's a desirable commodity, then there's a ready market for it, and unless you're keeping continuous inventory records, it's not likely to be discovered. Whereas cash will be discovered the next time there's a cash reconciliation. So cash is a stupid thing to take, and people taking cash are themselves stupid. People taking anything are themselves stupid, because eventually you will be found. But inventory is the desirable one. You don't see many people taking buildings, do you? They're misappropriating a building or misappropriating a car, a motor vehicle, office equipment, all right, the occasional calculator may disappear. I think it was an audit of the House of Commons, I think it was the House of Commons, the Parliament, which discovered there were 80 laptops missing. Highly desirable. Communications by management with those charged with corporate governance concerning the processes adopted for the identification and response. Those charged with corporate governance are the non-executive directors who, out of their number, make up the audit committee, and management, the executive board, should report on a regular basis to those charged with governance, the non-executive directors, and particularly the audit committee. And it's the executive directors whose responsibility it is to identify risks and potential fraud areas, and they ought to report to the non-executive directors stroke audit committee on a regular, frequent basis about what steps they have done to identify the risk and what steps they are taking to minimise the chances of that risk actually occurring. So that's what this one says, communications by management with those charged with governance concerning processes adopted for identification and response. Communications by management with employees concerning their views about business practices and ethics. Am I right, it's Germany where they have a workers' representative on the board? Am I right? In Germany, on the board of directors of a public company, there is a representative from the workforce, not the executive management, not the board of directors, but within the board of directors there is a workers' representative. Who better to identify and communicate with the rest of the board and the audit committee than someone who's on the shop floor, who's on the manufacturing floor, to identify the risks that they perceive in their day-to-day manufacturing activities? It makes a lot of sense to me. I don't know, does it happen here? Do you find many workers' representatives on the board of directors? No, I doubt it. Do you have many companies with audit committees? No. Your auditors in the room, do you find many audit committees in your audit clients? No. It will be a requirement as you get deeper and deeper into the European culture. It will be a requirement in the foreseeable future. And you. Probably your head office does.
In Greece?
No. Where's your head office?
In Chicago.
Of the group? Where's the parent? Where is it?
In Chicago.
In?
In Chicago.
In Chicago. So therefore you're subject to Sarbanes-Oxley. Yeah. And they will have an audit committee. They will have non-executive directors. It's a bit of a non-concept to think about a relatively small subsidiary company having audit committees, but there will be an audit committee in the group. And communications, discussions with internal auditors. These are the prime source of information or identification of risk. The prime source, the internal auditors. But the internal auditors are only an extension of management. They're appointed by management as an internal control. And if you go back to your F8 days and the definition of internal control, the start of that definition says, by internal control is meant not only internal check and internal audit, but the whole system of controls established by the management. So internal audits are themselves an internal control, but they're an extension of management. Management has established this internal control called the internal auditors. And the internal auditors, acting as direct agents of management, have a prime responsibility for the identification of risk areas and therefore the management of those risk areas. Procedures when there's an indication that fraud or error may exist. If you become aware of information which indicates the existence or the suggestion that it may exist, then you need to obtain a thorough understanding of the nature of the event and the circumstances. You should aim to gain an understanding of the possible effects. One of the techniques I suggest you may use within P7 is where it asks what are the business risks, what are the accounting risks that the company faces, financial statement risks that the company faces. A way in which you may adopt to help you answer it is to think, how would I go about misappropriating assets? How would I cheat the company? What would be the way in which I could begin to cheat the company? Because if you can think of it in 5 minutes, you can guarantee that the employees have thought about it in 5 years, and then you can begin to address that risk and think about how to establish controls which would manage that risk. Though we have an expression in England that says, set a thief to catch a thief. The best people at catching thieves are thieves because they know the way they operate. And if you can think of weaknesses within a system, then you can guarantee that the employees have already identified those weaknesses. Auditors should document their findings and communicate them to the appropriate level of management. But there is, in theory, and maybe not over here, there is in theory a close relationship and close liaison between the audit committee stroke non-executive directors and the external auditors, as well as these charged with governance with the internal auditors. One of the prime sources of information going to the non-executive directors audit committee comes from the internal auditors, and the chair of the non-execs will meet with the chief internal auditor on a frequent, regular basis in order to discuss progress and risk identification, procedures adopted to manage that risk. The external auditors have got the use of the reports made by internal auditors, and in your own external audit work, it should be without question that you use the internal auditors' reports in order to help you to understand the risks that the company faces. It's a common question within P7. Identify the business risks. Identify the financial statement risks. Identify the audit risks. 3 different types of risks that the examiner could ask you about. Page 9, reporting to third parties. We need to consider whether the matter should be reported to a proper authority in the public interest, and if it is in the public interest, we take legal advice because there's no definition of public interest. If, after obtaining that advice, the auditors conclude the matter should be reported to an appropriate authority in the public interest, they should notify the directors in writing of their view, and if the entity itself doesn't report the matter, or is unable to provide evidence that they have reported it, then the auditors themselves should. But it's not always the case that you're going to notify the management. That itself could be a criminal activity. So there are situations where you mustn't report to management and say, this is what we're going to do. Where a suspected or actual instance of fraud cast doubt on the integrity of directors, you make a report directed to the proper authority. I came across one. It was a new audit client for me. It didn't happen, I have to emphasize this, it didn't happen while I was the auditor. But it was a situation where the client was involved in buying sheets of aluminium, big sheets of aluminium, maybe 2 meters by 1.5 meters, and they were shaping them by a machine so that it made shaped roofs, or the wall cladding typically for sports centres. And of course with this, and you're shaping it and bending it and cutting bits off to cut it to shape, they employed one individual whose sole job it was to keep the factory floor clear of cut off pieces of aluminium. And they had a skip, a receptacle for putting in these cut off pieces of aluminium. The idea then was that when the skip was full, it would ring up a scrap metal merchant who would come, take it away, weigh it, and pay money to the company. And the director didn't want to. There was only one chief executive and one other, almost a sleeping director. He didn't want to be hassled with the, inverted commas, problem of recording the sale of this scrap aluminium. So he said, pay me cash and the workers can share it amongst themselves. It's a sort of bonus for keeping the place clean, tax-free, undeclared. Bonus for keeping it, the factory floor clean. And the workers very quickly realised that if they could fill the skip faster, they could get the money faster and have the tax-free bonus in cash faster. So they were getting sheets of aluminium off the inventory racks, cutting it up and putting it into the skip. So it never went through the process of shaping and forming and cutting. It just got taken off the racks and cut up and put in the skip. Why they bothered cutting it up? Why not just take it off the rack and put it in the skip? Defeats me. That would have been quicker still. But he discovered what was happening when he realized that his stock was going down rather quickly. He discovered what was happening. He had 33 employees. He sacked 30 of them. The other 3 were proved not to be involved in this. He sacked 30 of them on the spot and reported them to the police, and they were charged with theft. Management themselves should run a tight ship, and if you don't, you pay the price. It was his fault. It was the chief executive's fault. He should never have allowed it to happen. He should have recorded the sale properly. But that happened in the year before I was involved. A fourth bullet point, page 9. Following matters should be taken into account when deciding whether disclosure is justified in the public interest: the extent to which the fraud is likely to affect members of the public, whether the directors have taken steps to correct the problem, or are they likely to take corrective action, the extent to which non-disclosure is likely to enable the suspected or actual fraud to continue, the seriousness of it, and the weight of evidence and the degree of the auditor's suspicion that there has been fraud carried out. What is the format of an ISA? I did say I'd ask you tomorrow, but I'm asking you today instead. But we did it about 2 pages ago. Introduction. Objectives, well done. Yeah, disclosure.
Activities.
Yes, regulation. And application. Application. Definitions, requirements, and application. Introduction, objectives, definition, requirements, application. Professional liability. To whom do you owe your duty of care? You owe your duty of care as auditors to the company. But you don't owe your duty of care to individual members. The company is the members of the company, the people who own the shares. But I don't owe my duty of care to you, or you, or you, or you, or you. I don't owe it individually. I owe my duty of care collectively to the group of you, acting through your majority. And if I breach that duty of care, it's the company acting through the majority of its members that can take action against me. My duty of care is not to individuals, it's to the company. And if I breach that duty of care, it is not available for any individual member to take action against me. The company can take action against me, but not an individual shareholder. Then that's the duty of care which is owed by the auditor to the client, and it's owed in contract. But there's another type of duty, and that's a duty which is owed in the law of tort. And the law of tort says that we all of us have a duty to look after everybody else, that I should not be guilty of activity which hurts my legal neighbours. Now, my legal neighbours are not the people that live next door to me or above me in the apartment block. Those are not my legal neighbours. My legal neighbours are those people who are so directly affected by what I do that I should have had them in mind when I did those actions. As drivers of cars, we all of us owe a duty to obey the Road Traffic Act, but we also have a duty of care to other road users. So we shouldn't frighten them. We shouldn't wait for some old lady crossing the crossing in front of us and then rev the engine or sound the horn and frighten them. We're breaching our duty of care. So all of us should bear in mind, doctors have a duty of care not to kill their patients. Accountants have a duty of care to act in a professional way and not to be negligent in their acts. And so in order to establish a duty of care, in order to establish that an accountant auditor is guilty of breaking the principles of the law of tort and therefore injuring somebody else, you have this 5-step approach to adopt. And you have to satisfy all 5 elements, in which case the auditor may then be found liable in negligence. We have to establish, first of all, that a duty of care exists. Quite clearly with the doctor, the duty of care is obvious, because he shouldn't kill his patients by his negligence. So it's called the proximity test, or legal neighbours, and I've told you what the legal neighbours are, who the legal neighbours are. Those people so directly affected that you should have them in mind. In the context of an accountant auditor, where you're auditing a client and the audit is negligent and you give an inappropriate audit opinion, that is, you give a clean opinion and it should have been a dirty opinion, if the client then shows those financial statements to a bank asking for an increased overdraft, you should have realized that the client is going to ask for an increased overdraft and that the financial statements would likely be shown to some third-party lenders, potential lenders, and therefore you owe a duty to these other third-party lenders. You should have realized that people would rely on those financial statements, as well as the company, the members in aggregate, relying on those financial statements. So you would, in that situation, owe a duty of care to the bank. You have to establish that that duty has been breached. That is, the auditor has issued a negligent opinion. You've issued a clean opinion, it should have been dirty, and therefore, quite clearly, you have breached that duty. The third party has relied on the auditor's work. Their resultant action shall be shown to have been based on the fact that they're looking at your inappropriate audit opinion. And if they can show that what they did was because they relied on your opinion, then they can prove reliance. The next step is that they have to show that they have suffered financial loss. In the context of a bank advancing an overdraft or increasing a loan to a client company, then they can show now that the client is in liquidation. They can show that they have suffered a loss, which only resulted because they gave the additional loan facility, and they only gave the additional loan facility because they relied on your inappropriate audit opinion. So we're all right so far. We've got the situation where everything has been satisfied. All these 4 rules of principles are satisfied. But now we have to see this 5th one. The loss suffered was caused by the third party's reliance on the auditor's work and is not due to any other cause. Were they going to extend the loan anyway, or were they going to extend it but maybe not by as much? They would have extended it by another 100,000, but based on your audit opinion, they've increased the loan facility by 150,000. Now in that situation, the financial loss that they have suffered is not entirely due to reliance on the audit opinion. They were going to suffer a loss anyway. It's just the degree of the loss that they've suffered. And the courts are not prepared to subdivide it into 100,000 and 50,000. They say, you've lost 150,000 and you didn't rely purely on the auditor's opinion. You were already going to lose some money. You were going to lose the 100,000 already. So the auditor would escape negligence in that case. The Caparo case you may remember from your F8 days, if you remember anything from your F8 days. Do we remember anything from F8? No? No. Okay. The Caparo case, just read it. Second line there, Caparo invested in and eventually acquired control. They did have an investment of 7% of Fidelity. But as a result of the audit opinion they made a bid and successfully acquired the remaining shares. They alleged that financial statements they had relied upon overstated the profits, and in fact they did. It was established that they had not been prepared according to IFRS or according to Statements of Standard Accounting Practice, the UK equivalent. And in fact, it showed a profit, it should have shown a loss. The case went to the House of Lords. I really ought to change that. The case went to what is now called the Supreme Court. It was called the House of Lords at the time. It was decided that proximity did not exist. There was not a close enough relationship between the auditors and Caparo. An essential element of proximity is that the defendant, Touche, knew that the statement would be communicated to the plaintiff, either as an individual or a member of the identifiable class. Touche knew that their audit report would be shown to all the shareholders, and Caparo was a shareholder, specifically in connection with a particular transaction or transactions of a particular kind, and that Caparo would rely upon it. Well, we didn't. We didn't know that Caparo was going to use the audit report as the basis for a bid. The claim by Caparo was rejected. There was another reason it was rejected. We didn't owe a duty of care to Caparo. We owed a duty of care to 100% of the shareholders, not to a 7% shareholder. So if they had wanted to succeed in an action in negligence against the auditors, the company acting through its majority should have sued, and it didn't. The company couldn't, because the majority of members had made a profit. The ADT case, ADT acquired control of Britannia's security, which was audited by BDO, it's called Binder Hamlin in the UK. Before they made a bid, there was a meeting. Two boards of directors, Britannia and ADT, sitting down at the final meeting before the bid is announced. And Britannia had asked their auditor to be present at this final meeting, a man called Martin Bishop. At this meeting, the partner was asked if he stood by the results of the 1989 audit. Here's me, a director of ADT, and I'm saying to the board of directors of Britannia, I said, "Excuse me, gentlemen, can you tell me that these 1989 figures are true and fair?" And they naturally turned to their auditor, Martin, and said, "Martin, maybe you'd like to answer that question." So they asked Martin, "Are these figures true and fair? Are they reliable?" And Martin said, "Yes." And that was probably the most expensive 3 letters that Martin has ever said. Because they weren't reliable, and BDO were found liable in negligence for issuing a negligent audit opinion, but particularly for Martin, their partner, for saying yes. ADT successfully showed that they did not rely on the audit report. They relied on the oral confirmation by the partner. Are these figures reliable? Yes. £105 million, 35 million per letter. Yeah, 35 million. 35 million. Binder Hamlin got taken over by Arthur Andersen in the UK. And the partners of Binder Hamlin then became, having paid out 105 million, they actually paid 55 million because they were insured up to the extent of 50 million, but out of their own pockets they had to pay 55 million. And then they got swallowed up by Arthur Andersen and became partners of Arthur Andersen. And the rest is history. What happened to the partners of Arthur Andersen? What a disaster. One disaster following another. Limiting liability. This is another frequent, regular visitor to P7 exams. What are the arguments in favour of auditors being able to limit their liability in the event of a successful negligence action being brought against them? It's important that we should be ring-fenced as auditors, as partners of audit firms, If you become a partner of an audit firm, a partnership, you are unlimitedly liable for the debts of the partnership. And if the other partners can't afford to pay any in and they're bankrupt, you have to stand the 105 million. It's up to you. It's a personal liability, right down to the value of your private estate. And it can destroy individuals, innocent individuals. Let's say we're all in a partnership, an accountancy partnership. By my negligence, I issue an inappropriate audit opinion. The firm is successfully sued, and I have no money. So you have to sell everything you've got. All your second homes, your timeshares, the motorboat, the light aircraft that you have, all your shares and your investments, everything has to be sold in order to raise the money to pay off this 105 million. Because I was negligent. Where's the fairness in that? Well, you shouldn't have taken me on as a partner. If you can't rely on your partners, you don't take them on as partners. So it's become common practice now for firms of auditors to ring fence, to build a fence around their own personal assets, to protect them from personal disaster in the form of having to sell all your possessions. And the ways in which it can be done, the ways in which it has been done and is now common, is either create a limited liability partnership, which I believe is now available here in this country. I think with effect from 1st of January this year, you can now create a limited liability partnership or the equivalent. You can either have a limited liability partnership where the partners, some of the partners are limited in their liability, and there's at least one partner who has unlimited liability. A very wealthy one, presumably, and gets compensated by an additional share of profits. Or you can create a company, like your audit firm has done, like your audit firm could do. You can create yourself into a company, and I noticed the letterhead not long ago, KPMG Audit PLC. It's a public company which has to be audited. So KPMG itself is audited, and their financial statements are a public record at the Registrar of Companies. So that's another way of protecting yourself, because you then own shares in the company, and your limit of liability as a shareholder is limited to any unpaid value of your shares that you hold. But you can't be held responsible for KPMG audit liability. It's the company which is liable, not the individual shareholders. Or you can do what Germans do. The Germans have a cap to their liability. I understand, I may be wrong, but certainly down the bottom bullet point there, currently not permitted by audit work in the Companies Act 2006, but it's permitted in other countries like Germany, where they can cap their liability in the event of negligence. Yes, okay, the client, the losing client can sue, but the maximum liability that the German firms are prepared to accept, I think it's capped at 500,000 euros. You'll never be asked the figure in an exam, what is the cap in Germany for audit liability. But you can establish it by having a cap on your liability and say, we will not be liable beyond €500,000. Expectation gap. This is a strange thing. What do you understand by the expression expectation gap? The expectation gap arises because the world out there really has no idea what auditors do. We move in a mystical world. We move in a world which only auditors and accountants and maybe some solicitors understand. We go into a little audit room and we close the door and we ask for records and books so that we can inspect them and put magical marks on them, and then we hand them back to the client, and the client's busy looking through to see what magical marks you've put on their records, and looking through particularly at June. Did they spot that mistake I made in June? And it's wonderful. I don't know if it happens nowadays with computerization, but it's wonderful to say thank you very much and give the paperwork, the documentation back to the client. Say thank you very much, and they'll say, is everything all right? Oh, yeah, it's okay, it's all right. And then you go out of the room and you count to 50 quickly. And then you come back in and they're busy looking to see what marks you've put on their records. Have you never done that? Gone back into the room suddenly, unexpectedly, and seen that they're busy checking to see what you've done, the magic marks that you apply. You've never done that? No? Have you ever checked through the magic marks? No. Expectation gap. Auditors work in a mysterious way. And because the people don't understand what we're doing, there is this expectation gap. It's at the parties. I was never good at mathematics at school. They think you add up. They think you design frauds and then catch them. They think that's what auditors do. You seek out fraud. And it's totally wrong. The expectation gap, lack of competence, lack of independence, lack of education. It comes down to a lack of education. That the world out there doesn't know what we do. And if we were to be able to educate the world, then they would have a better understanding of the work and the role and the position and the functions of auditors. The profession's response to this lack of competence, rules on the issue of practicing certificates. You can only get a practicing certificate to practice in the UK if you've passed the UK tax exams, the UK law exam, and the UK variant of the Advanced Corporate Reporting exam, P2. If you want to practice as an auditor in the UK, you have to have passed the UK variant of P2. That will change. That will change within 2 years, I imagine, as UK gets closer and closer and closer to a full adoption of IFRS, and then the international P2 will be sufficient. Post-qualification educational requirements, CPE and CPD, continued professional education, continued professional development. On the monitoring of audit activity, CPD, continued professional development, when you're qualified, unless you work for an approved employer, so any of the big four, and others, like your national bank is an approved employer, unless you work for an approved employer, you have to do 40 hours a year continuing professional development. This may apply to you, for instance. You have to do 40 hours a year. 21 of those hours must be certifiable, and you'll have a certificate. This certifies that this person attended a course on Advanced Corporate Reporting or IFRS updates. So 21 of those hours have to be certified. Every year, 40 hours. The other 19 hours, you can do those by self-assessment, by determining that you're learning things all the time, your professional employment requirement, professional employment record. By reading Student Accountant or an accountancy magazine, you can claim 1 hour a month for that. So that's 12 hours of the remaining 19 that you need. But you will have to continue in your professional development throughout the course of your ACCA membership. Monitoring audit activities is done by the Joint Monitoring Unit. And the Joint Monitoring Unit, as I was leaving the UK 10 years ago, the Joint Monitoring Unit had just brought in the concept that monitors would visit all practicing firms holding a practicing certificate, and determine the quality of the audit work that those firms are carrying out. So they would come through and they would select, all the files have to be available for them, all the current and previous year audit files are available for them, and they would select at random to see whether all the I's were dotted and all the T's were crossed and all the letters of engagement. And it applies internally as well to firms like PwC, where on a regular 2 years, I think, basis, a partner from another country from PwC, a partner from another country will come and visit PwC here in this country, and they will monitor the quality of the audit work which is being carried out to see that it's up to PwC standards. That's the Joint Monitoring Unit. It's a joint unit because it comprises, or it's funded by, all the branches of the profession. So it's the Chartered Accountants of England and Wales, Chartered Accountants of Scotland, Chartered Accountants of Ireland, ACCA, and there are 3 other elements as well. The Chartered Institute of Professional Financial Accountants, Public Financial Accountants, CIMA, the Chartered Institute of Management Accountants. So the profession has created this joint body which will then go around and monitor the quality of work which is carried out by professional accountants in practice. Page 11, disciplinary procedures following investigation of apparent failure. If you fail that joint monitoring unit, if they say this is wrong, we'll give you 6 months. We'll come back in 6 months' time to see that your standards have risen to the required limit, to the required level, and if they haven't, we're going to take away your audit registration certificate. You will no longer be a registered auditor. So you just lose all your audit clients. So you have to comply with that. And as I was saying, just as I was leaving the UK, previously they would visit all registered auditors every 3 years, at least once every 3 years. As I was leaving, they just changed that to every year. Every year, every firm which has an audit register and certificate is visited by the monitoring unit. It maintains the standards of the profession. Joint disciplinary is another joint body, and they administer disciplinary proceedings. So if you fail in your professional conduct, then they will punish you. And earlier we had Ivana writing to Indra, asking if there were any professional reasons why Ivana shouldn't take on my audit, and Indra asked my permission to reply. And I did give you permission to reply, but you failed to reply. You didn't respond to Ivana's letter. So Ivana writes again, and you still don't reply. So Ivana sends a third copy of the letter with the additional bit that says, in the event that you don't reply, I shall assume there are no professional reasons and I shall accept the invitation. A copy of this letter has gone to ACCA. ACCA will then be in touch with you and say, we understand that Ivana has written to you on 3 occasions and you've not yet replied to her. Is there any reason you've not replied? The only thing you can do is say, yes, I died last week. That's the only exception. Or I'm in prison and the prison authorities didn't get the letter, didn't release the letter to me. So you've no excuse. You have to. And that's a joint disciplinary thing. And they will punish you. And they will charge you, I think the last time I saw it, it was something like £800 for failure to reply to a professional reason letter. So it's a bit expensive operation. It may be difficult to separate lack of competence, lack of independence. Technical competence and honesty or independence are interrelated. Technical competence and honesty and integrity, they're clearly related. If you're a person of integrity, then presumably also you're a person who's competent. Misconduct. I told you about the Big Four partner and his train ticket. There was another one, a qualified accountant in Leeds. And he was found guilty of conduct calculated to bring disrepute to the profession. And this particular accountant had a liking for ladies' underwear. And when the washing was hanging out in the back garden on a summer evening, he would go into these houses, back gardens, and steal the underwear, women's underwear, from the washing line. And he had an enviable collection of women's underwear at his home. And he was an accountant. How does that happen? Surely you're more interested in columns of figures rather than women's underwear. But that was misconduct. And he was, his qualification was taken from him on the basis that he was not a fit and proper person to be an accountant. The world respects accountants, but not those who steal underwear. Misconduct refers to acts likely to bring discredit, convictions relating to personal life of members and students, obtaining money or goods by false pretenses, forgery, theft, bribery involving dishonesty. If you are found to be receiving bribes or giving bribes, for instance to policemen who stopped you from speeding, stopped you because you're speeding, if it's the case that you are discovered to be offering a bribe, then that is conduct calculated to bring disrepute to the profession. And you would be, I know it wouldn't happen here, but you would be banned from taking any further exams, and you would never be able to qualify. So if you know any people in countries which are subject to widespread bribery, then maybe you should be telling them that it's misconduct. Investigations, disciplinary appeals committees will decide each case on its own merits. Penalties imposed reflect the view that the committee takes of the offence. PII, I'm not going to read through that. Can you read through that for yourselves? Insider dealing, using inside unpublished price-sensitive information to make a gain or avoid a loss. Clearly, an auditor is in possession of that unpublished price-sensitive information, and it will be a criminal offence for the auditor to use that information to make a gain or avoid a loss. Money laundering. There's a good article on money laundering. Where did I read it? I think it was in Student Accountant. I may be wrong there, but I think it was in Student Accountant where a really good article was written. I'll see if I can find the reference for you, and if it's not in Student Accountant, I'll download it off my computer. Just read through money laundering now. One of my former colleagues has just got out of prison. He was found guilty of money laundering £26 million. And of course, if you're found guilty, you then have to compensate the government and pay that £26 million back. So he was fined £26 million, as well as serving a 6-year prison sentence. But he was the head of centre of the tuition company that I used to work for in the UK. And he was the sort of local chief executive officer. And as a result of being fined 26 million, he had to sell everything that he owned in order to try to raise 26 million. Can you imagine me trying to raise 26 million by selling everything I own? Oil-stained shirts. And can you imagine me getting 26 million? Well, they couldn't get 26 million off him. They could only get 14.5 million pounds from the sale of his assets. 14.5 million. I can't even imagine what that looks like written down, let alone own property and assets to that extent. Where did he get 14.5 million from? Commissions on money laundering, presumably. And 6 years. He should have served 14 years, shouldn't he? And that last bullet point on page 12 there, the offence of failure to report relates to you in the course of your business. Auditors, accountants. If you fail to report money laundering, you are yourself an accessory, and as such, you are equally liable. What's tipping off? That third one in the penultimate bullet point. What's tipping off? Do you know? Tipping off is where I suspect that you're money laundering, and I say, look, I've worked out what you're doing, I know how you're doing it, I'm going to tell the authorities. So to tip off is to notify the criminal that you're going to report him. That's tipping off, to give him a tip. Just a quiet word. Jonas, I know what you're doing. I know you're laundering money. I'm going to tell the authorities. What does Jonas do? Rushes home, packs his bags and emigrates to Burkina Faso. Where people will no longer be able to find him.